Hello, my name is Andrea Villarreal, and today I'm going to perform a ratio analysis from two different industries, the airline industry and the telecom carrier industry. I chose five companies of each of these industries. For the airline industry, I chose Republic Airways Holdings, United Continental Holdings, Southwest Airlines, JetBlue Airways, and Spirit Airlines. For the telecom carrier industries, I chose T-Mobile, US Cellular Corporation, CenturyLink, AT&T, and Verizon Communications. For the airline industry, a little bit of overview. I performed a supply chain analysis, and I found out that 4 out of 5 of these companies have Amadeus IT Holding as their supplier, and 3 out of 5 of these have General Electric and United Technologies also as their supplier, which means that they can be affected the same. That these companies would be affected the same way in case one of these suppliers goes bankrupt or something like that. And also only Southwest Airlines pays a dividend. I'm gonna go one company at a time and performing this analysis. For Republic Airways Holding, I consider them the losers of this industry. They have a decreasing current, quick, and cash ratios. Their ROA is 1.9% and it's 70% below industry average. Their equity multiplier has been decreasing, but it's still above average, and their economic value added has been negative for 3 out of the 5 past years. And if you can see in this graph, they have their ROE, the profit margin, and the return on assets. It was negative in 2011, and it hasn't been higher than 10.98, and the industry average is of 22%. This company doesn't have any ratio that outperforms the industry, so that's one of the main reasons why I consider them the worst company. By using Bloomberg's dividend discount model, their theoretical price is 6.78 and their current stock price is 4.50. I calculated their price for 1 year from today using the PE ratio and their projected earnings per share, and I came up with a projected price of 2.64. Also, their PE ratio is 7.65, which means that investors don't really think that this company has a bright future. Now going to United Continental Holdings, they have a current, quick, and cash ratio that have been decreasing, and they're also below industry average. The only ratio that they have above average is their asset turnover. Their equity multiplier is of 13.76, which is really high for their industry. And their ROE, you can see that is highly driven by leverage. Their profit margin and their ROA have been really low, but they come up with a high return on equity because their equity multiplier is really high. Their dividend discount model theoretical price is 213 with 14 cents, and their current stock price is 58.07, and the price 1 year from today is 164.85. Now I had some trouble choosing between Southwest, JetBlue, and Spirit to come up with the best company for this industry because all of them seem to have really good numbers. For example, Southwest Airlines, they have the highest enterprise value, which means that they have the highest theoretical takeover price. But their economic value added has only been positive this past year. Their profit margin is just below the average with 6.11%. They have high PE and price to book ratios, and they also provide a dividend yield. They're the only company in this industry, but it's really low. It's 0.61%. Their ROE is below average with 16.10%, and they have increasing asset turnover, increasing profit margin, but they have also increased their leverage ratio, which causes their ROE to increase as well. According to Bloomberg, their theoretical price should be 99.34, and their current stock price is 47.62, which Bloomberg thinks that they are currently underpriced. And their price based on their earnings per share for next year should be 70.74. Even though Southwest number look pretty good, JetBlue's also look as good. Their current quick and cash ratios are lower than industry though. Their profit margin is above average. Their return on asset is just below average. They have had a positive economic value added for the past 3 years. They have an increasing ROE and decreasing equity multiplier, which is a really good thing because that means that they have increased their profit margin and their return on assets, and they have an increasing enterprise, also an increasing enterprise value. Bloomberg theoretical price is 151.38, while their current stock price is 25.59, and their price 1 year forward is 43.94. Even though these ratios look really good, having their increasing ROE and a decreasing equity multiplier, Spirit's numbers are just the best. They have a current quick and cash ratios above average, and average is 1.02, and they have their current ratio of 2.0. So that means that they're the best industry that can take on that can cover their short-term debt. They also have the lowest equity multiplier and the highest ROE. That means that they have the highest profit margin and hence the highest ROA. So the industry average of their equity multiplier is 5.77 and they only have 1.57. It can be shown that the past 3 years, this is zero right here because it didn't come up with ROE numbers, but since 2013 and 2014, they have had increasing ROE, and their equity multiplier is not as high as the industry. And as you can see, their profit margin and their return on assets are way higher than the industry. They also have a high interest coverage ratio, and their PE ratio has been increasing over time to 24.53, and they also have the highest price to book ratio. I wouldn't consider them overvalued since they have a high PE and price to book ratio, but I would consider investing on them. Bloomberg's theoretical price though is lower than their current stock price, but their price 1 year forward, taking into account their PE ratio and their projected EPS, is 99.22. So I would consider Spirit the best company for this industry. Now looking at the telecom carrier industry, they have really their ratios are different than a regular industry. They have low current quick and cash ratios because they're also a service industry. Their asset turnover is below 1. Their return on asset is 1.5%. They have a low profit margin of 3.3%, but they all have a high times interest earn ratio, and it's above 1. The clear loser after performing the ratio analysis is T-Mobile. They have had decreasing cash, quick, and current ratios. Their ROA is below 1%, and their ROE is barely 1%. It's 1.65. Their economic value added was negative from 3 out of the 5 past years, and they have had an unstable enterprise value, which means that investors don't really know what T-Mobile is worth. Their leverage has also been increasing, but since their ROE are really low and their equity multipliers are really high, and coming up with an ROE of 1.65 is really low, and an ROE of 0.4 in 2013. Next is US Cellular. They have a good current ratio, but their cash ratio is below the industry. They have a steady ROE before 2014, ranging from 3 to 5%, but this is not even close to industry average, the industry average of 10%. They haven't had a positive economic value added, but they do have a stable enterprise value. Although also their asset turnover has been falling. As you can see here, they had a negative ROE in 2014, and their leverage ratio has also been increasing which makes their ROE increase in these periods also. Now coming up next is CenturyLink. They have had lower ratios since 2011. As you can see, they had a big downfall in here, and they also have their cash ratio is 0.03, which is really low because that means you don't have any cash on hand for any day-to-day operations or any or unexpected expenses. They do provide a dividend yield of 8.0 now, but after looking up at their dividends, they have cut their dividends were cut this past quarter, which means that which is not a good sign for investors. Also, their equity multiplier has been increasing, and they only experienced a positive economic value added in 2014. They also had a negative profit margin in 2013, causing a negative ROE. And you can see they don't have a really stable ROA or ROE. Now AT&T, their current quick and cash ratios have been increasing, but they have really unstable ratios per se. As you can see, it goes up, it goes down, it goes up by a little bit, then it goes up by a lot more, and then they go down. They have been increasing their leverage constantly, which means that in here their profit margin and their return on assets have been low. And this big downfall in 2014 doesn't say a good thing, which that can turn out to have their PE ratio was lower, which means that that companies really don't know what AT&T is, don't know about AT&T's future. And lastly, the one that I consider the best of this industry is Verizon. Their current quick and cash ratios are above the industry average. They have the highest and increasing economic value added, and they also have the highest enterprise value. The only bad thing about Verizon is that they have a really high leverage ratio. But in here, in 2012, the difference between the leverage ratio from 2012 to 2013 is not as much. So the difference in the ROE doesn't come from the leverage ratio, but from the profit margin and the total asset turnover. And in their ROE has been increasing, but not only because of the equity multiplier, but because their profit margin and their ROA and their total asset turnover are higher than the industry. And the theoretical price from Bloomberg is 63.83, and their current stock price is 45.03. Calculating their projected price for next year is 55.03. One more thing, if Verizon would take the same leverage as the industry, which is 4.4, they would still have the highest ROE. So that's why I'm still sticking with Verizon as my best company. Now, which one between Spirit and Verizon is the best? I came up with the best company being Spirit Airlines. Even though these two, comparing between two different industries is a little bit odd, they are both service industries, so they kind of have the same assets. And so I chose Spirit Airlines because they have better liquidity ratios. Verizon was just able to cover their short-term debt with a current ratio of 1.02. But also Spirit's ROE is way less driven by leverage. If Spirit were to take on the same leverage as Verizon, which is 9.9, they would outperform Verizon by 6 times or more, a little bit more than 6 times. They also have higher profit margin, higher asset turnover, and hence a higher ROA. Even though Verizon has had better economic value added than Spirit still has a positive EVA, and even though Verizon has a really high enterprise value, a takeover price, Spirit Airlines has had an increasing, their enterprise value has increased significantly over the past few years. So these are the main reasons why I consider Spirit the best company out of these two industries, especially because they have a really high ROA and a really low enterprise equity multiplier. So that's my recommendation of today, and thank you for watching.